Hey everybody, Smart Silver Stacker here. Welcome to another live stream. A series of alarming data points continue to reveal the weakness of the US economy, and that this weakness is worse than what we are being told. Now, this weakness ultimately will result in the Federal Reserve printing vast quantities of dollars. At least that's my forecast, and when that happens, the price of gold and silver are going to move in a very big way. Now, let's get right into the first piece of data that we're going to discuss in today's video. This is the JOLTS numbers for October, and this is a number that reveals the number of job openings in the economy. And this number came out significantly below estimates, 8.73 million versus 9.3 million job openings estimated. This is the lowest level since the pandemic lows of March 2021, and this is a tremendous sign of a slowing economy and a weakening job market. Now, why is this important? Well, the strength of the job market is one of those factors that the Federal Reserve has repeatedly pointed to as they forecast a soft landing, saying that their tightening has not affected the job market. Well, it is beginning to affect it in a very big way. And so as we know that the Fed is quote unquote data dependent, according to Jerome Powell, this weakening job market will certainly give them cover and also provide a significant impetus to begin easing economic conditions. Now, the inflation fight is not won by any means. Anybody who goes and buys groceries should be well aware of that. But this economic weakness that we're beginning to see really, I think, is pointing towards the Federal Reserve easing soon. And markets are convinced of that. We'll get into some of those numbers in just a moment. Now, take a look at the price of gold. $2,017 today. Now, gold did spike and hit an all-time high just a few days ago. But now we have seen a nice pullback. And I view this as a significant opportunity to buy into this physical asset, and silver as well. I mean, silver is the cheapest one of all, basically, one of the most undervalued assets on the planet. But part of the reason that we're seeing gold lingering around these new all-time highs, if you ask me, is that investors are becoming convinced that the Fed is going to print. I'm not the only one who believes this, but the fact that prices have pulled back a bit here, I think, is nothing more than a gift. And when the Fed really begins to print, which will likely be sometime in 2024, we're going to see all-time highs that exceed even the 2150 level that was hit the other night. If you want to get some gold and silver before that happens, check out sdbullion.com. That's where I buy my gold and silver. Right now, new customers can get gold or silver at spot by visiting sdbullion.com/new. Now, let's get into the next piece of data, which shows that the U.S. economy is weaker than we are being told. And if you're in the live stream, hello, welcome. Do me a favor, smash that like button, put a 1 in the chat just to help wake up the algorithm and to let me know that you can hear me loud and clear, or let me know that you can hear me loud and clear. All right, so this is the next one. U.S. factory orders fall 3.6% in October. So consumers are weakening. We know that they're at the end of their rope. The credit card balances are at record highs. The amount of balance that is not being paid off every month is at a record high. The number of consumers carrying a balance is at a record high, and savings are near all-time lows. So what does that mean? Well, it means that people don't need to buy as much stuff, or they simply can't, and that means you don't need to make as much stuff. So factory orders are on the decline. New orders, according to this report here on Reuters, new orders for U.S.-made goods fell more than expected in October, marking the biggest monthly drop in roughly 3.5 years. So think about that. Again, back to pre-pandemic levels and below this. I mean, think of everything that's happened over the 3.5 years that we've just gone through, and yet factory orders now falling at the highest level in that time period. Also, September orders downwardly revised, so further bad news. This is all from the Commerce Department Census Bureau, and they released these numbers yesterday. This is the biggest monthly drop since April of 2020. Economists polled by Reuters had forecast orders would decline 2.8%. Orders advanced 0.5% on an annual basis. So they were anticipated to drop 2.8%, but they fell 3.6%. That is not good. And this is going to lead to more layoffs. If factory orders are falling, you don't need as many employees. So we are going to see further job weakness as a result of this declining demand for durable goods. Here we have the chart from the Fed of the rate of change in manufacturers' orders for durable goods. And you can see that now we are getting down to very low level. This is something you tend to see in economic contractions and economic slowdowns. And this chart is likely to get much worse throughout 2024, possibly dropping to lows as we saw during the great financial crisis and also during 2020. So there's still room to fall here, but the orders are falling at a quick pace now, and this decline is accelerating. Now, if that doesn't convince you that the U.S. economy is slowing and the Fed is going to have to begin printing quite a bit of currency in order to avoid a complete collapse of the system, look at this. From Bankrate, delinquency rates are at the highest level in almost 30 years. And what are they talking about here? Well, they're talking about delinquencies on auto loans. So the last time this many drivers were delinquent on their auto loans was when the first mobile flip phone entered the market in October of 1996. This is according to data from Fitch Ratings, examining the percentage of borrowers at least 60 days past due on their loans in 2023's third quarter. So let's take a look at this chart here to show you just how high the rate of subprime delinquencies is getting. I mean, it's higher than it was during the 2020 crisis. It's higher than it was during the great financial crisis, the highest level of delinquencies in 30 years. So people are being laid off. The number of people who are having to work multiple jobs just to make ends meet is at a record high. And now delinquencies in this, what I would consider to be a leading indicator, subprime auto is probably where you're going to see delinquencies tick up first, as these are going to be the consumers at the biggest risk for delinquencies. And as conditions continue to remain tight, this is a trend that will accelerate across all types of credit. Now, what can the Fed do to reduce this problem? Well, they can cut rates. It's a lot easier to service debt and to make your debt payments when the interest rates are very low, near zero perhaps. Now, as rates have been rising, the delinquency rates on these loans is moving higher, and it's not going to change until the Fed cuts. Now, let's take a look at what markets are gleaning from this. This is a CME FedWatch tool. This is the December 2024 forecast. Okay, so about as far ahead as this tool goes. But look at the target rate. So right now, the target rate for the Federal Reserve's federal funds rate is 525 to 550. And according to this tool, there is a 0% chance priced in that will be the case by December of 2024. Now, it seems like the forecast is split among how far the Fed will cut, with some people, some even 1.5% of investors anticipating that we're going to get as low as 325 to 350 basis points. But when are they going to start this, according to the CME FedWatch tool, which has been pretty accurate in terms of forecasting what the Fed is going to do next as of late? Well, the December meeting seems like everybody pretty much agrees that they're just going to keep rates where they are. And I don't think that the Fed can begin to cut yet because that would be just too much of a sign, too much of a capitulation, and too much of an admission that the U.S. economy is not as strong as they have been telling us. But once you get to January here, you can see a 14.5% chance of a Fed rate cut as early as January. You go to March, that level goes up to 55.7%, only 35% chance of rates staying where they are. And there's an 8.4% chance of deeper rate cuts. And you can see as you go through time here, the percentage chance of a rate cut just, increases as you move forward, which is to be expected considering the fact that the economy is absolutely falling apart, and investors are beginning to get the idea that the Fed can only keep the wheels on this machine for a short period of time before they are absolutely forced to begin cutting rates. And as an indication of how much of a global crisis this is, and it's not just relegated to the US, look at this story from Reuters. Moody's has now cut China's credit outlook, citing lower growth and property risk. So we know that the Chinese economy is not perfect. They have a lot of problems over there. They have Evergrande right now is in hearings for like a debt restructuring or being forced to liquidate their assets. They've got a lot of problems over there. A lot of it has to do with debt, just like here in the US. And debt, of course, is a global problem. The amount of leverage in this economy is absolutely massive. All of these fiat currencies, the yuan included, are simply in a race to the bottom. But we need to look at what the Chinese are doing in response to this rate cut, because it will have an effect on the dollar. So let's get into this story here. Ratings agency Moody's cut its outlook on Chinese government credit ratings to negative from stable on Tuesday, that's today, in the latest sign of mounting global concern over the impact of surging local government debt and a deepening property crisis in the world's second largest economy. The downgrade reflects growing evidence that authorities will have to provide more financial support for debt-laden local governments and state firms, posing broad risk to China's fiscal, economic, and institutional strength. That's what Moody said in their statement. Take a look at this. China's major state-owned banks, which have been supporting the yuan currency all day, stepped up U.S. dollar selling very forcefully after the Moody's statement. One source with knowledge of the matter said the yuan was little changed by late afternoon. So imagine what might have happened with the currencies had they not been selling U.S. dollars. Yuan might have plunged, right? But you got to remember, China holds a lot of U.S. dollars, trillions of dollars of reserves. And if they really want to dump those in a big way to defend their collapsing economy, that could spell a big problem for the U.S. and specifically for the Treasuries market. I mean, look at the data here from the U.S. Treasury regarding large foreign holders of U.S. Treasuries. And you can see China, the number 2 holder, and they have been on a debt dumping spree for some time now. According to this data, in 2022, September, they held $901 billion worth of U.S. debt. And then 1 year later, in September of 2023, $778 billion. So they dumped more than $100 billion worth of U.S. treasuries in the span of a year. But if this economic crisis accelerates, say there's a liquidity crisis, a rush for cash, I mean, China could dump their U.S. Treasury holdings in a very rapid way. And of course, that would be a big problem because that would lead to spiking yields on U.S. debt. Well, who's going to come into the market and buy that debt up to keep rates from exploding? Well, if you said the Federal Reserve, that's correct. The Federal Reserve will be forced to monetize all of these treasury notes that end up getting sold by major foreign holders. And as you can see, Moody's downgrading China's economy. They begin accelerating their dumping of U.S. dollar-denominated assets. Well, as the meltdown in the global economy continues, you can expect more of that. So that is going to lead to a lot of money printing by the Federal Reserve. I know investors are beginning to kind of price this in. When we look at the FedWatch tool, that for December, basically everybody is on board that there's going to be rate cuts by that time. But the thing that I think that markets are missing is how significant the rate cuts are going to be and how significant the programs of debt monetization will have to be to bail out this massively over-leveraged global economy. So leave me a comment down below to let me know what you think. Stay safe and happy stacking, everybody.